Hello, everyone. Andrei Niezviesny here, which means you're tuned in to the episode of our podcast, Millionaire Invest Club. With us is our permanent macroeconomist and trader, Stas, and today we're going to talk about what's happening in Iran and the financial consequences this is having worldwide. If you thought last year was volatile, buckle up. Hi, Stas.
Hi, Andre. Wishing profits to all our listeners. You asked me before the show if I was tired of talking about Iran. No, I'm not, because right now the entire global economy is being rewritten right before our eyes. What's happening in the Middle East isn't just a local skirmish, it's a full-blown perfect storm that has already gutted the deposits of thousands of traders.
Well, what can you do? We just haven't had any other news of this magnitude delivered to us. So since our last podcast on March 19th, the following has happened. The Middle East has completely turned into a powder keg. The Iranians obliterated the world's largest LNG plant in Qatar and an Israeli oil refinery in Haifa. The Strait of Hormuz is de facto closed, and the Pentagon, judging by leaks in the Washington Post and Axios, is seriously preparing for a ground operation. Let's start with the alignment of forces on the geopolitical board. What exactly is going on?
Look, the situation has spiraled out of control for absolutely all the players. The Iranians have shown their teeth in a way no one expected. They struck not only Israel with ballistic missiles, but also the US-UK base on the Diego Garcia atoll in the Indian Ocean, and that, mind you, is 4,000 kilometers away. A lot of people in NATO are having their hair stand on end right now because this range means Iran can potentially reach Europe. The only country their missiles currently can't reach is Portugal. In response, the US is amassing huge forces. 3,500 Marines have been deployed on the amphibious assault ship USS Tripoli. Strategic B-52 bombers have flown to the Fairford base in the UK. In Congress, they're openly talking about a ground operation and seizing the Iranian Karg Island, which is their main oil artery.
But at the same time, Trump keeps posting on his social network, sometimes giving 48 hours to open the strait, then moving the deadline to April 6th, and then outright declaring that they're having very successful secret negotiations and he's taking a 5-day pause. Meanwhile, Iran is twirling a finger at its temple and officially stating, "There are no negotiations until you leave the Gulf and pay us reparations." Who should we believe?
You have to believe the charts and trading volumes, Andre. Trump's tweets are currently the most powerful manipulation tool. It's called jawboning, verbal interventions. There was an absolutely wild insider trading scandal. Just 15 minutes before Trump posted about these mythical productive negotiations, somebody poured $580 million into short positions on Brent and WTI oil and simultaneously bought $1.5 billion worth of S&P 500 futures. Oil instantly crashed by over 10% on Trump's tweet, while the stock market rallied. Those behind these trades made over $100 million in pure profit out of thin air in half an hour. It's just a perfect Trump pump and dump. Meanwhile, Iran has calmly allowed ships from China, India, and Russia to pass through the Strait of Hormuz, but they are demanding $2 million per transit from Western ships, state-level racketeering.
Insane. So China is the biggest winner here?
Absolutely. Beijing is gaining a colossal competitive advantage, while Europe and the US are overpaying astronomical amounts for logistics around Africa, paying crazy insurance premiums and burning expensive fuel. Chinese tankers are calmly passing through Hormuz. Plus, they're vacuuming up Russian and Iranian oil at a huge discount.
Let's move on to the main fuel of all this panic, oil. Brent has broken through $116 a barrel. What's next?
$116 is for futures, paper oil. In the physical market, if you need actual delivery from Dubai, prices have already gone into the stratosphere. The Saudis are saying it plainly. If a US ground operation starts, we'll see $150, maybe even $180 a barrel. Saudi Arabia, by the way, is saving the world as best it can right now. They've pushed their east-west pipeline to maximum capacity, pumping 7 million barrels a day to the Red Sea, bypassing Hormuz. But that's not enough to cover the deficit from the Strait's blockade.
How is Russia feeling in this situation? You think with oil at $116 and Iran as their friend, Moscow should be swimming in money, right? The news flashed that the Kremlin's oil revenue doubled from $270 million to $760 million a day.
Here's where it gets really interesting. On paper, revenues have grown, yes, but in real life, Ukraine has aggressively entered the game. While the US is distracted by the Middle East, Ukrainian special services are just methodically, every single night, taking out Russian oil infrastructure. The terminal in Ust-Luga is damaged, and that's the largest port on the Baltic. Primorsk is burning. Drones are hitting refineries in Tatarstan, Tanako, and striking Slavneftyanos in Yaroslav. Russia has lost up to 40% of its export capacity. Do you see the irony? Oil prices are historic, but there's physically no way to sell it and ship it. Ports are burning, logistics are stalled. It's gotten to the point where the Russian government is completely banning gasoline exports from April 1st, even for the producers themselves, to prevent a domestic deficit. Putin is already gathering oligarchs like Deripaska and Sechin, demanding they voluntarily chip in for the war because the budget is bursting at the seams.
Let's move over to Europe. It looks like they're starting a second 2022 over there. European politicians are panicking.
For Europe, this is a disaster worse than 22. They entered this spring with gas storage levels around 30%. Iran's strike at Qatar on the Ras Laffan complex, which provided 17% of Qatari exports, is a knockout blow for the European LNG market. Prices at the TTF hub have skyrocketed past €60 per megawatt hour. That's a 100% jump in a month. The IEA is already openly telling Europeans, switch to remote work, lower your speeds on highways, save fuel.
So we should expect inflation on food?
Guaranteed. Gas isn't just heating and electricity. Gas is the foundation for producing nitrogen fertilizers like ammonia and urea. And the Strait of Hormuz is also a global artery for sulfur and phosphate shipments. Urea prices have already shot up 50 to 70%. India is halting its fertilizer plants right now due to lack of raw materials. If farmers don't apply fertilizers in the spring, we won't have a harvest in the fall. By the summer and fall of 2026, we're looking at a global food crisis and a new spiral of rampant inflation, and Europe will take this hit first.
Listen, reports mentioned that Iran is threatening to strike Microsoft and Google facilities as well as submarine cables in the Red Sea. Plus, Qatar. How does this affect the tech sector? Everyone here believes in big tech.
The tech sector is under three troubles right now. First, the cables. Up to 30% of global internet traffic between Asia and Europe goes through this region. Repair ships can't go in there. Insurers won't green-light it. Plus, there's the physical threat of shelling. Second, Qatar isn't just gas. It's one of the world's largest suppliers of helium, and helium is critically necessary for cooling and semiconductor manufacturing. No helium means no chips. No chips means assembly lines halt for Tesla, BYD, Volkswagen. Plus, logistics. Cobalt and lithium from Asia and Africa now have to be rerouted, making EV production unprofitable. Airlines are sheer pain. Due to fuel prices and closed airspace, shares of Wizz Air, EasyJet, and others are just bleeding out into the abyss. $53 billion in market cap has been wiped out from the aviation industry.
Okay, let's move on to the most important part for our investors, portfolios. Stas, explain a paradox to me that I absolutely don't understand. There's a massive war going on, missiles are hitting oil bases, strategic bombers are deployed. It smells like World War III. According to all the economics textbooks, gold should be flying to the moon. Yet it fell by 15%, nosediving from $5,400 to $4,600 an ounce. Silver is falling too. What kind of nonsense is this?
Andre, it's not nonsense. It's the harsh mechanics of the stock market that they don't write about in basic textbooks. It's called a liquidity crisis and margin calls. Let's break it down. Because of oil prices, inflation is accelerating again. The U.S. Federal Reserve cannot lower the key interest rate in these conditions. On the contrary, they will keep it high. The yield on 10-year U.S. Treasury bonds has soared to almost 4.5%. The dollar index is showing incredible strength because the dollar is currently the ultimate safe haven. When major hedge funds see their equity positions burning due to market drops and the S&P 500 is very choppy, they urgently need cash to cover brokers' margin requirements. What do? They sell what can be sold quickly and profitably. Gold was wildly overheated at the beginning of the year, trading at historic highs, so funds started dumping gold en masse into order books to save their core positions. Billions of dollars were pulled out of gold ETFs in a matter of weeks. This isn't a flight to quality, it's a flight to cash. The dollar is king right now.
Mind-blowing. What about crypto? Bitcoin is holding up.
Yes, and that's a surprise for many institutional investors. Bitcoin is trading above $71,000, showing a 7% gain since the escalation began. On the first day of the war, it dumped to 63K amid general panic, but it was bought up instantly. You know what's most interesting? The historical correlation between gold and Bitcoin is broken right now. Gold falls, crypto rises. A new generation of investors is starting to perceive Bitcoin as a real hedge against inflation and geopolitical risks. The only risk for crypto right now is if Iran actually cuts the main internet cables. Then the volatility will be insane due to some nodes dropping off and retail investor panic.
Okay, let's summarize for our